Hello everyone. Today I want to talk about mortgage insurance because I think it's a topic that it might frighten people a little bit. People don't exactly know what's going on. They just kind of think these old hard and fast rules of you got to put 20% down or you have mortgage insurance and mortgage insurance is bad. And that's not necessarily the case, and actually I think things have changed pretty significantly, so I'm kind of going to give you an updated opinion. In fact, my opinion has actually changed based on what I'm seeing in the lending environment at the moment, as opposed to as soon as 6 months ago. Obviously, things have changed pretty drastically in the last 6 months, and the lending market has changed as well. So let's just take things from the top. What is mortgage insurance? So traditionally, when you put 20% down on your loan, that's enough equity into a property. That means your own skin in the game in the property, that the banks consider the loan less risky. They assume, hey, you've got enough money in there that you're going to take good care of it, so you're less likely to default on the loan. Because at the end of the day, your mortgage rate is simply an expression of risk. 20% down, you're less risky. Less than that, they consider you more risky because you don't have as much equity invested. But there is the ability to put less than 20% into the property when you purchase it, and instead you get something called mortgage insurance. Now, mortgage insurance essentially just is an extra payment per month. It's a premium that covers the lender should you default on your loan for that particular 20%. Now, a lot of people know that mortgage insurance goes away when you hit 20% equity in the home. That's not entirely true. Specifically, legally speaking, mortgage insurance is required to go away automatically when you hit 78% invested into the loan. You can request it to be removed in writing at 80%. Why? I haven't the slightest idea. But basically, if you're watching your mortgage payments, the moment that you hit 80% invested, and it'll tell you on your sheets and you'll be able to calculate it, you can request in writing to your loan provider, please remove my mortgage insurance. And in many cases, you're not necessarily paying that mortgage insurance for that long. In fact, people want to diminish the amount of time that you're paying that mortgage insurance because it doesn't go into equity. It doesn't go into the amount that you actually get to keep as a part of the money that you are invested in your house. So many people that get mortgage insurance, maybe they're actually just doing it for a certain period of time, in which case, maybe they're getting a big bonus or they're getting some kind of inheritance, and they're like, okay, great. I'm gonna have this mortgage insurance for, a little while, a couple years, maybe even less. I'm gonna pay it down. Boom, I'm gonna get rid of that mortgage insurance. So, or some people just say, hey, I actually want to go ahead and I like this house. I don't have the cash reserves to go all the way to a 20%, but I can make the monthly payments. Maybe they don't have as much money for a down payment, but they have really high income. So now previously, this is where it comes to my opinion has changed based on what's happening in the lending market. Like I said, as recently as 6 months ago, I was really encouraging my buyers to save for a 20% down payment. It avoided the mortgage insurance, it lowered your monthly payments, and specifically back then, it was actually getting you a pretty significantly better interest rate. Again, interest rates are an expression of risk. So when you had less money invested, not only were you getting hit with the mortgage insurance, but you were also getting hit with a higher interest rate, so a higher monthly payment. So it's kind of like the 1-2 punch. And I was like, from a financial perspective, I just don't really recommend that. Now, what's happening with today's interest rates being so low, people are actually able to get mortgage rates that are just as low. Dare I say, in some instances, very specific instances, lower by putting 10% down. So in those instances, obviously, this is something where it's very, very important to be able to work with somebody who's a local lender, somebody that's able to be, pick up the phone and run the numbers and really work with you to get the best rate possible. There are actually instances where I'm like, look, if you can get that rate, go ahead and put 10% down. That is not bad at all. I mean, with interest rates hovering in the low threes, historically speaking, that is, again, very, very cheap money. So in that instance, it actually might financially be totally okay to have a lower down payment than 20% and pay off that mortgage insurance in a handful of years. Now, I want to address something really interesting that I got a question recently about this, and I actually didn't know the answer to myself, so I did a little bit of research. And the question was, okay, what happens if I purchase a property and I take on mortgage insurance and the value of that property drops? Am I going to still be able to cancel my mortgage insurance when I hit 20%? The answer is, fortunately, yes. So the cancellation of the mortgage insurance is based on the equity at the time that you made the loan. So once you hit 20% of that original appraised value, whenever that was, whether that was 6 months ago, whether that was 5 years ago, that is what holds. You would have to do some kind of triggering event to have to reevaluate, like a refinance or some kind of cash out refinance or something that would cause a reappraisal. However, if you think about that, if your property value is actually rising, whether that's due to just the market in general or that's due to maybe some improvements that you've made to the property, then you can actually request a new appraisal, and you could remove that mortgage insurance even earlier if the appraised value goes up. But let's just say crazy scenario and the property value has gone down. As long as you don't reappraise, you are locked in. If you did a 30-year fix, you are locked in at those payments for 30 years, no matter what, and that actually is very comforting to a lot of people when they're borrowing at, 3.1, 3.2, 3.3, 3.4%, these low monthly payments. They're like, great, as long as I'm locked in at that, I'm good to go. So that's kind of a high-level overview on mortgage insurance, how it's changed at the moment, and at least in terms of my opinion, and kind of hopefully it's a little bit of information to make it a little bit less scary. Again, I think, generally speaking, if you can get 20% down on your property, in most instances, that's just going to be a better scenario, but I feel as though in the current market right now, more than ever, it's far more okay. It's far more okay from a financial perspective to put less money down, especially if you're getting some really, really fantastic interest rates. So anyway, there you go. There's kind of a high-level view on mortgage insurance. If you have any questions, throw a comment below. Reach out, obviously, shoot me an email or give me a quick call. But yeah, this is something that a lot of people are talking about right now, so I figured to make a little video on it.